Hello everyone and welcome to Educare 247. This is the fourth lecture in the series on economic and social issues. Today we'll be discussing MCQs related to balance of payments. This series is important for RBI, NABARD as well as SEBI Grade A examination. Now before moving forward, Educare 247 brings you SEBI Grade A 2020 crash course which features around 5000 plus MCQs with concise content and live doubt sessions to help clear your queries. To avail the benefits of this course, you can log on to the website and apply coupon code SEBI to get 1500 rupees off on the course. Now moving on, let us understand what is balance of payments. Balance of payments is a consolidated account of the receipts and the payments from and to other countries arising out of all economic transactions during the course of a year. By all economic transactions, we mean individuals, firms, and government. By all economic transactions, we mean the transactions of both visible goods, which includes merchandise, and invisible goods, which includes services, assets, gifts, etc. In other words, the BOP shows how money is spent abroad and how money is received domestically. Thus, a BOP account records all payments and receipts arising out of all economic transactions. All payments are regarded as debits, that is, outflow of money, and are recorded in the accounts with a negative sign, and all receipts are regarded as credits, that is, the inflow of money, and are recorded in the accounts with a positive sign. The IMF defines BOP as a statistical statement that subsequently summarizes for a specific time period the economic transactions of an economy with the rest of the world. Speaking about the components of a BOP, it comprises of current account and the capital account. Speaking of the current account, it includes all transactions arising from trade in currently produced goods and services, from the income accruing to capital by one country and invested in another, and from unilateral transfers, which include both private and official. The current account is usually divided in three subdivisions. The first of these is known as visible account or merchandise account. This account records imports and exports of physical goods. The balance of visible exports and visible imports is called as the balance of visible trade or balance of merchandise trade. The second part of the account is called the invisibles account since it records all the exports and imports of services. The balance of these transactions is known as the balance of invisible trade. As these transactions are not recorded in the customs office, unlike merchandise trade, we call them invisible items. It includes freights and fares of ships, planes, insurance and banking charges, foreign tours, and education abroad. It also includes the transactions of out of interest and dividends on foreign investments and so on. The difference between merchandise trade and invisible trade is known as the balance of trade. There is another flow in the current account which consists of two items, that is the investment income, which consists of interests, profit and dividends on bonus and credit. Also the interest. For example, the interest earned by US resident from the telco share is one kind of investment income that represents a debit item here. There may be a similar money inflow that is a credit item. Transfers such as gifts, grants, pensions are such that no reverse flow occurs, or these are the items against which no quid pro quo is demanded. Residents of a country receive them cost free. Thus, unilateral transfers are one-way transactions. In other words, these items do not involve give and take, unlike other items in the BOP account. Thus, the first three items of the BOP account are included in the current account. The current account is said to be favorable or unfavorable if receipts exceed, that is, fall short of the payment. The second component of the BOP includes the capital account. The capital account shows transactions relating to international movement of ownership of financial assets. It refers to cross-border movements in foreign assets like shares, property, or direct acquisition of companies, as well as bank loans. In other words, capital account records export and import of capital from and to foreign countries. The capital account is divided into two main subdivisions, short-term and long-term movements of capital. A short-term capital is one which matures in 1 year or less, such as bank accounts. Long-term capital is one whose maturity period is longer than a year, such as long-term bonds or physical capital. Long-term capital account is again of two categories, which includes direct investment and portfolio investment. Direct investment refers to expenditure on fixed capital formation, where portfolio investment refers to the acquisition of financial assets such as bonds and shares. For example, if an Indian company acquires a new Coca-Cola plant based in the USA, it represents an outflow of money. Similarly, if a foreigner acquires a new factory in India, it will represent an inflow of funds. Thus, through acquisition or sale and purchase of assets, capital movements take place. Investors then acquire controlling interests over the assets. Remember that exports and imports of equipment do not appear in the capital account. On the other hand, portfolio investment refers to changes in the holding of shares and bonds. Such investment is portfolio capital, and the ownership of paper assets like shares do not ensure legal control over the firms. Suppose a US company purchases a firm operating in India. This sort of foreign investment is called capital import rather than capital export. India acquires foreign currency after selling the firm to a US company. As a result, India acquires purchasing power abroad. That is why this transaction is included in the credit side of India's BOP accounts. In the same way, if India invests in a foreign country, it is a payment and will be recorded on the debit side. This is called capital export. Thus, India earns foreign currency by exporting goods and services and by importing capital. Similarly, India releases foreign currency by importing visible and invisibles as well as exporting capital. Coming to the MCQs. Which of the following factor forms the invisible account on the balance of payment of a country? Option A. International trade and services. Option B. Income associated with non-resident assets and liabilities. Option C. The remittance of worker income. Or D. All of the above. So the correct answer here is D. That is all of the above. Balance of payment broadly comprises of current and capital accounts. The current account records export and import of goods, that is, the visible items, while the export and imports of services form a part of the invisible items and unilateral transfers from one country to another. Invisible account of the balance of payment registers exports and imports of services such as tourism, banking, and insurance, software services, etc. The invisible account, along with the trade account, constitutes the current account of the BOP. Moving on to the next question. Which of the following is a part of the capital account of a country? And the options are A. Export and import of goods. Option B. Export and import of services. Option C. Unilateral transfers from one country to another. Option D. NRI deposits. So the correct answer here is option D. So as we have previously discussed, the capital account shows transactions relating to the international movement of ownership of financial assets. It refers to the cross-border movements in foreign assets like shares, property, or direct acquisition of companies as well as government securities. In other words, capital account records export and import of capital from and to foreign countries, and it is divided into two main subdivisions, that is, short term and the long term movements of capital. Moving on to the next question. Consider the following statements regarding autonomous and accommodating transactions in the balance of payments. First, autonomous items in the BOP take place due to some economic movement. First, autonomous items in the BOP take place due to some economic motives like earning income and profit maximization. Second, accommodating items in the BOP refer to transactions that take place to cover deficit or surplus arising from autonomous transactions. So the options are only first one is correct, B, only second one is correct, C, all of them are correct, or D, that is, none of them is correct. So the correct answer here is C, that is, both of them are correct. Autonomous items in BOP refer to international economic transactions that take place due to some economic motives like earning income and profit maximization. These items are generally called above the line items in BOP. Again, it is autonomous transactions which make deficit or surplus in the BOP. They have nothing to do with the foreign exchange requirements since such transactions are independent of the state of the country's balance of payment. That is, it is irrespective of whether BOP is favorable or unfavorable. A BOP is in deficit if the autonomous receipts are less than the autonomous payments, while it is in surplus if the autonomous receipts are greater than autonomous payments. Coming to accommodating items in the BOP, these refer to transactions that take place to cover deficit or surplus arising from autonomous transactions. They are also known as below the line items. They are present only in the case of capital account. Because of government financing, official settlements are seen as accommodating items to keep the BOP identity. Moving on to the next question. The current account of the balance of payments includes first, foreign aid, second, foreign institutional investments, third, remittances. And the options are A, both 1 and 2 are correct, B, 1 and third one is correct, C, only the third one is correct, or D, second and third is correct. So the correct answer here is B, that is only 1 and 3 are correct. Foreign institutional investment are a part of the capital account as well as remittances and foreign aid come under the heading of transfers under the current account. Current account refers to an account which records all the transactions relating to export and import of goods and services as well as unilateral transfers during a given period of time. It contains the receipts and payments relating to all transactions of visible, invisible, and unilateral transfers. Coming to the components of current account, it includes the export and import of goods, which includes merchandise transactions or visible trade, and export and import of services, which are a part of the invisible trade. These services are generally of three kinds, which includes shipping, banking, and insurance. Payments of these services are recorded on the negative side and receipts on the positive side, while the unilateral transactions or one-sided transactions includes gifts, donations, personal remittances, and other one-way transactions. These refer to the receipts and payments which take place without any service in return. Moving on to the last question. Which of the following is considered as a part of the external sector of a nation's economy? And the options are first, current account, second, capital account, third, imports, or fourth, external debt. Which of them is correct? A, first, second, and third one is correct. B, only second and third one is correct. C, only the first and third one is correct. Or D, all of them are correct. So the correct answer here is D, that is, all of them are correct. All the economic activities of an economy which take place in foreign currency fall in the external sector and includes exports, imports, foreign investments, external debt, the current account as well as the capital account. The external sector is the portion of a country's economy which interacts with the economies of other countries. In the goods market, the external sector involves exports and imports. In the financial market, it involves capital flows. The economic features related to the external sector includes balance of payments, current account, capital account, foreign direct investment, external debt, exchange rate, as well as foreign exchange reserves. So that's it for this lecture, but prior to ending it, I'd like to inform you that Educate 247 brings you a comprehensive course for RBI Grade B 2020, which covers subjects such as economic and social issues, finance and management, along with comprehensive coverage of current affairs in the form of MCQs. So you can log onto the website to avail the benefits of the full video course. Thank you and happy learning.